On June 2nd, the American stock market sat near a record high, and Warren Buffett's Berkshire was buying Alphabet stock. At the very same moment, Bitcoin broke below $70,000, and the most valuable companies in the world were all lining up to raise money at once. Strength and stress in the same breath. Inside 48 hours, Alphabet announced an $80 billion equity raise. SpaceX filed for a $75 billion public offering, and Anthropic filed to go public at nearly $1 trillion, more than $150 billion of new stock announced in 2 days. So where's the edge now? It isn't in the issuance, everyone can see that. It's in reading what the issuance tells you, and this issue reads it. This is the Asymmetric, Issue 4, the Tell, Tech and Crypto Investing for Thoughtful Retail, written from an operator's lens. Issue 3 walked the terrain. Today, the financing of that terrain became the story. $155 billion of new equity announced in 48 hours. It isn't bearish by itself. The demand for computing power is real, and the buyers, Berkshire among them, are serious. But issuance at this scale, by companies that don't need the cash, is the clearest late-cycle signal of the year. The marginal dollar is moving from demand to supply. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, what moved today. The 30-second frame. The Federal Reserve is on hold, between 3.5% and 3.75%, but the cut bias is gone. The market now prices a small chance of a hike by year-end. Inflation is sticky near 3.8%. Gold sits near $4,500, but cooling off its January peak. And the S&P is near a record, with the top 10 names about a third of the entire index. Start with rates. After April inflation ran near 3.8%, the highest in almost 3 years, the market flipped. It no longer prices cuts. It prices roughly a 1 in 4 chance of a hike by December. The 10-year yields about 4.5%. Higher for longer is now the base case, not the risk. Friday's jobs report is the only thing that could revive the cut story. The dollar is soft, and gold is up modestly on the day, but notably below its late January peak near $5,600. The backdrop for real assets is intact: central bank buying, reserve diversification, heavy government issuance. Yet gold has stalled while equities sit at highs. That stall is itself a tell. The marginal risk dollar has been chasing artificial intelligence equity, not the hedge. Now the structure of the market. The top 10 names are about 36% of the S&P 500. The catch today: the company doing the issuing, Alphabet, and the chip names that benefit are the same handful of stocks that are the index. They now carry both its gains and the capital supply risk of funding the whole build-out. Concentration cuts both ways. Against that sits a live energy tail. Crude is near $92, with the president floating that a deal to reopen the Strait of Hormuz could come within a week, even as Iran weighs a full closure. The consensus expects de-escalation. Volatility is subdued, but thin spare capacity makes a real disruption a fat tail, and a signed deal would gap oil down. Genuinely two-way risk, priced cheaply. And the headline itself: $155 billion of issuance in 2 days, Alphabet's $80 billion raise, SpaceX's $75 billion public offering, and Anthropic's confidential filing at nearly $1 trillion valuation. Demand is consensus, and it's priced. The new information is on the supply side, and supply this fast usually clusters near tops, not bottoms. Put it together: sticky inflation with the cut bias gone, gold cooling while the index sits at record concentration, a live oil tail, and the new news: a capital wave that says the build-out now needs outside money at a scale even the cash-richest companies can't self-fund. The regime doesn't say sell everything. It says the reward is in the uncrowded, cash-generative corners, plus dry powder. Part 2, today's lead event: the data, the structure, and the debate. Alphabet, when a company that prints cash still raises $80 billion, read the structure. $30 billion is an underwritten public offering, half of it a mandatory convertible preferred. $40 billion is an at-the-market program that sells stock into the market over time, starting in the third quarter. And $10 billion is a private placement to Berkshire, bought at roughly a 7 to 8% discount to the market price. The reason for all of it? A capital spending line guided near $180 billion this year, roughly double last year. So is it rational funding or a top-of-cycle tell? The bull case: this isn't about solvency, it's avoiding draining the balance sheet with cheap convertible capital and a rare Berkshire endorsement. The bear case: Berkshire got a discount, public buyers eat the dilution at market, and when even a cash machine has to raise $80 billion, the arms race is too big to self-fund. The stock fell on the news. The line to watch: spending climbing toward $300 billion next year without the revenue to match. The crypto reality check: Bitcoin slid below $70,000, its first time under that level since April, down about 6% on the day. It trades as a high beta liquidity proxy, not digital gold, with the Fed's cut bias drained and the risk dollar chasing artificial intelligence equity. The marginal buyer left crypto first. The structural thesis is intact, but the near-term setup is a knife, not a coiled spring. 65 to 70,000 is the zone to watch. Part 3: How to read a week of mega issuance. First, demand is priced, supply is information. Second, read the capital structure. Berkshire didn't chase common at market, it negotiated a discounted block. Where the smart money sits is the tell. Third, the edge migrates away from the crowded mega-cap trade toward the cash-generative picks and shovels funded by this spending: power, electrical equipment, low-cost gas, and the cheap quality the crowding has buried. What we are watching this week: Friday's jobs report, the only near-term revival of the rate cut story; the pace of Alphabet's at-the-market sales; how SpaceX is offering prices against a $1.75 trillion target; the Strait of Hormuz, whether Bitcoin holds its zone; and the European Central Bank, expected to hike, a reminder that higher for longer is global. And we keep score in public. Alphabet, quality but patient, let the issuance settle. Cigna, attractive, EQT spelled EQT, constructive on weakness. Eaton, watchlist, full price. Bitcoin, constructive but entry sensitive. Micron, Nvidia, Coinbase, all watchlist, each with a specific number to watch. Dated, falsifiable calls, and we grade them. So where does it land? Today, the financing of the map became the story. Issuance at this scale is a late-cycle tell. Follow the senior, discounted money, not the common at the highs. The edge is still the uncrowded, cash-generative corner, power and electrical equipment funded by this spending, cheap quality the crowd buried, plus dry powder, because Bitcoin's break and the oil tails show the volatility isn't priced. That's the tell. The asymmetric turns filings, flows, and market data into one disciplined read for investors who want the evidence, not the noise. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.